Hello everyone, I'm Rakshith Pai and today I'll talk about one such company where people flock into the store as if they're selling things for free. There will always be people inside the store with groceries and other apparel, and the crowd gets bigger each day. Yep, I'm talking about Avenue Supermarts Ltd, widely known as DMart. Is it worth investing in? Business introduction. ASL operates an organized retail chain through its DMart brand name. The company was founded in 2000 by Mr. Radhakishan Damani, an investor in the equity market. DMart operates 263 hypermarkets in 11 states and 1 union territory. Align Retail Trade Private Limited (ARTPL) is a wholly owned subsidiary company under the brand name DMart Ready. You might have heard of this. ARTPL purchases grocery products from local agricultural produce market committee, packages them and distributes them to ASL, that is Avenue Supermarts Limited. The success of DMart goes to Mr. Damani and team. I'm pretty sure the high premium or the premium valuation the company quotes is mainly due to the man behind the company. Sri Radhakishan Damani established a corporation that is intrinsically motivated to develop a thorough awareness of client needs and desires and work towards meeting them with appropriately priced items. Indian consumers are highly price sensitive in nature, and as a firm believer of fundamental business principles and strong ethical values, he has built DMart into an efficient and lucrative retail chain that is very well liked by customers, business partners and staff. The company's daily use items are classified as food, non-food and general merchandise and apparels. The chain operates on a business to customer, that is B2C basis, with goods being sold directly from the manufacturer to the end consumer. It has positioned itself as India's lowest priced store network. Low price result in increased footfall, which result in increased sales. DMart is able to quickly sell and replenish its inventory. This cycle attracts manufacturers that provide extra volume discounts, lowering the cost of DMart purchases. And DMart give all the available benefits to its customers. Financial information. DMart is valued at 3 lakh crore and is down 20% since its all-time high. The company has been giving comfortable return on equity and return on capital employed with very low debt. What bothers me is the valuation. We are looking at over 7 times in PEG ratio. And when it comes to revenue and EPS wise, the performance has been extremely good. Reserves has grown over 80 times since 2012. And year on year, revenue grew 22%, which was expected because the demand has come to the new norm. EBITDA PAT has grown double digit and 17 new stores were added in the Q3 financial year 2022 alone. The EBITDA margin is 9.6% and the PAT margin is at 6.4%. Because over 50% of the revenue comes from FMCG, merchandise and apparel, amounts to almost 20% of revenue. The company works entirely through self-owned stores, which enables it to operate with little or no debt, thereby strengthening its financial position. Additionally, the absence of leasing cost result in positive cash flow, which can be used to expand the business. Although the expansion and growth of independently owned businesses are gradual, they have their advantage. Almost 80% of all the existing stores are held by the company. The properties are held by the company. And these properties are stationed in prime locations. This business model is extremely profitable. You might have heard or you might have seen the similar business model in a company called McDonald's, wherein they benefit indirectly from the appreciation of the company's real estate. Conclusion. After accounting for the enormous possibilities in the organized B&M, that is brick and mortar, grocery size, a further re-rating is now contingent on either major progress in its online grocery operations or a significant increase in store additions, neither of which currently observable. It's pretty easy to say that the company is overvalued. But what we need to look ahead here on is whether the valuation sustains. And even if it does, maybe we may not see much growth here on. At over 120 PE, Avenue Supermart is extremely overvalued. But look, there are two types of companies that quote such high valuation. Number one, they quote such high valuation for whatever the reason may be, but never perform as efficiently as the valuation dials down sooner or later. I call it illusion valuation. It's not real. And the second type is, these are the companies who always quote high valuation and no matter what, but will live up to their expectation. DMart comes under the second option. Although DMart quotes high valuation, their performance hasn't been dull. You may feel like with such high valuation, where is the moat, where is the margin of safety, which is actually a sane question. For that, what I say is, along with the price and the margin, look at the growth. With sufficient growth, margin comes in, and with that, price will look cheap. I may go wrong, but it's a chance that I'm taking. Overall, I'll give 7 out of 10 rating. A slightly lower rating because of the premium I'm paying and the company is in my core portfolio at 5% weightage. That's it for today. Thank you for watching.